Good morning, everyone. This talk had its origins in the Greenwich office, where we found that sometimes there were misunderstandings or questions about exactly how New York law, tax law works and how it differs from the federal and the Connecticut. And so we did an in-house CLE on New York tips and traps. In New York, what exactly is the New York cliff? I want to get into that in more detail. As Casey mentioned, New York has an estate tax exemption of $6,580,000, and just like the federal estate tax exemption, it's indexed for inflation, but we don't know what that number is yet. A New York estate tax return is due 9 months after someone dies. And this is all identical to the federal estate tax return. But the New York estate tax is calculated very, very differently. One place it is the same is it does allow a deduction for anything that goes to a spouse, a marital deduction, as well as a charitable deduction for anything that goes to a charity. So far, so good. And so just as a general rule, if the New York estate is under $6,580,000, there's no New York estate tax. So as far as who has to file, and we frequently have this where we have clients, who have houses in both, let's say, Connecticut or New York and Florida and things like that. If you're a New York resident, you have to file an estate tax return if the amount of the estate is over the federal gross estate, plus any includable gifts, and I'll talk a little bit about how that's done. The estate of a non-resident has to file a New York estate tax return if the estate includes any real or tangible property located in New York and the value of the non-resident's federal gross estate, not the New York-based property. The federal gross estate exceeds the New York basic exclusion amount. So let's talk about ways to understand and also to address this New York estate tax cliff. So here's a general example. Let's say we have someone who dies in 2023 and they have a estate of $6,909,000. And it means that they exceed the exemption by $329,000. Because that estate exceeds the threshold, the entire amount of the estate is subject to New York estate tax. And the amount of New York estate tax due would be about $626,000. So there's a disconnect, right, between the amount that it's over and then the amount of tax that has to be paid. And as you can see in this table, there's like a phase-in period where the estate pays a piece, a little bit of tax, and then it falls off the cliff. But if you just look at, let's say, where the phase-in happens, the second line, $6,600,000 is a taxable estate. The amount above is only $20,000, and yet there's New York estate tax of $53,760. And you can see how this sort of plays out, where you have the phase-in, then the cliff, and then the break-even point where the amount above the exemption in the New York estate taxes is $7,251,000. I've highlighted that on the chart. So there is a way to address that. If you're over the break-even point, that's it. There's not a lot you can do. But one of the ways to address this issue is something called the Santa clause. So where you have a client who's in that phase-in part, you might want to think about advising them about adding this kind of provision to their plan. So what the Santa clause is a conditional bequest in a will or a revocable trust that happens if you're in that range. It's a bequest to charity that's only effective if you're in this zone. In other words, the charitable bequest is, you'll have a contingent charitable bequest if the client's in that range, and it'll bring the estate back down to below the exemption, so the estate's no longer subject to the New York estate tax. So let's go back and look at that chart, and let's look at that line 2 again. So we see that the amount of the New York estate, it's over by 20,000, but then, we have New York estate tax of 53,760. So what the Santa Claus would do would be to bequeath that $20,000 number to charity and eliminate the New York estate tax. So although something's going to charity, the net benefit to that family would be about $33,000, right? Because you're saving that disproportionate amount of New York estate tax by giving something to charity. So the Santa Claus makes sense for someone who's in that asset range. As you saw, we don't know what the numbers are for 2024, but if you have a client with assets below at or below $7,251,000, then it's worth having that discussion. If it's a single or widowed client who's then leaving things to kids, and obviously someone who might have a taxable estate. If they're under the New York exemption, then it's not really going to benefit. New York has another kind of goofy way of calculating its estate taxes called the clawback. So New York does not have a gift tax. You have clients that can make New York gifts and effectively get those gifts out of their estate. And it's not factored back in like the federal rule where you use up exemption. It's free and clear. So what's the catch? The catch is that New York has implemented a law that says that that's still the rule, but if the client dies within 3 years of making the gift, whatever they gave away is going to come back into the estate for purposes of calculating the New York estate tax. It's not literally going to come back. That gift is still going to be considered complete, but for purposes of calculating the New York estate tax, you're going to bring that back in. And that is designed to prevent people from making deathbed gifts. You have a client, you think they're pretty ill, make a gift so we can save your New York estate taxes. That's only going to work if they survive 3 years. But it's a great technique if it's something that they're interested in doing. However, I just want to give you a heads up on what the impact of that clawback might have in calculating the federal estate taxes. So the general rule is that state death taxes are a deduction for purposes of calculating federal estate taxes. But for New York, the IRS takes the position that the amount of the deduction for New York estate taxes is limited to the New York estate taxes that would have been imposed on the federal gross estate. And the federal gross estate does not claw back prior gifts, so that the state death tax deduction is going to be limited just to the New York estate taxes on what's in the federal estate, not that augmented, clawed back New York estate. Now, why do we know this? We know it because it's the rules, but we also know it because it came up on an audit in our Greenwich office. And we had taken the position that we were going to take the full New York tax deduction on the on the clawed back assets, and the IRS disallowed it, and we had some healthy conversations and then decided to concede that issue. There's very, very little law on this. So now let's flash forward a couple of months, and coincidentally, I had the same issue come up. But now I wanted to have that discussion with the executors. I said, I was just in an audit, and the IRS disallowed the additional New York taxes. And then the executor said, well, how much, is there any law on this? I'm like, not too much. They'll go, we're going to take our chances. We're going to take the full deduction. And in that instance, I got a federal closing letter with no changes. So what's the right answer? The right answer is to have a discussion with your executors, to talk to them about the pros and cons, and then let them make that decision. What you don't want to do, though, is just sort of default. Tax preparation software is likely to default in one direction or the other. I don't know, just depends on the software. So just have an awareness of what it's doing. Have that discussion with your executors and just understand going in, what may or may not happen. All right, we often get questions about how New York taxes an apartment, almost always in New York City, and how a non-New York resident might avoid these taxes. So generally, real estate are things on the ground and buildings on top of it. I'm not going to get into that. For purposes of this talk, I'm going to focus on the difference between co-ops and condos. Tangible property are things typically in a house, things you can touch, and intangible property are things like stocks and bonds and money. And that distinction is important when we talk about condominiums versus cooperatives, right? So they look the same, right? You're living in an apartment. You're paying somebody something maybe for rent or mortgage. And so on its face, they look very similar. But for property tax purposes and estate and gift tax purposes, they are very different. So, when you buy a house, you get a deed. And that's also what happens when you buy a condo. So a condominium is considered real estate. You get a deed, you become owner of the unit. When you buy a cooperative, though, you become owner of shares in a corporation that owns the real estate. And then typically there's a proprietary lease entered into with the corporation to lease the apartment. And because a cooperative is shares, New York law provides that that's intangible personal property. You own shares of stock, not real estate. So that's important from a estate and gift tax purposes. Now, I'm going to focus more on non-resident situations. Obviously, if you have a New York resident, whether it's intangible or not is not really relevant because they're taxed on their estate. But for non-residents, they're very interested in how New York might tax this. So if a non-resident dies owning a condo in New York, they will have to report that on a New York estate tax return. But if they own a cooperative, shares of stock, it's not reportable. And not only that, gifts of the cooperative aren't considered gifts, it's a gift of intangible property. However, just heads up, if you have a Connecticut resident, remember Connecticut does have a gift tax, so that intangible property, the shares of stock in the cooperative that Connecticut, your Connecticut resident owns, that's included in their estate for Connecticut purposes, and it would be considered a gift, a Connecticut gift as well. So you need to coordinate. For those of you that have Florida people, but then a New York cooperative, that's sort of the ideal situation, right? So, what can New York non-residents do about this? How can we convert New York real property to intangible personal property? And the answer is there's no great, there's no silver bullet for that. But one approach could include transferring the real property to an entity to change the quality. So instead of owning real estate, you own an interest in an entity, but that can get very complicated. So for example, you might think to transfer the real property to a single member LLC, right? So that means when you have an LLC, that you have a membership interest, which you might think about as intangible. However, that's not going to work. It's not going to work in Connecticut. It's not going to work in New York. If the entity is disregarded for income tax purposes, then it's also going to be ignored for estate and gift tax purposes. So maybe you could say, well, I'll then elect to treat the LLC as a corporation. Then it's not a disregarded entity anymore. Well, corporations come with all sorts of additional complications. You're going to have a separate tax reporting for that corporation. You'll have probable double tax when you make a distribution of the property. if there's no business purpose for setting it up that way, there is a distinct possibility that the New York authorities will just disregard it because they'll say you had no reason for setting that up. There are reporting requirements under the Corporate Transparency Act. Another thing you could talk about doing, and this one some people have been doing, is transferring to a multi-member LLC. So that's going to be treated as a partnership. And even if the other member is a spouse, then that can still work. But it's unclear. It's an untested area. So I have had some clients who have done this or are thinking seriously about it. But you have to ask your clients, what is their appetite for tax audits? Because if there's no business purpose for this, so I have clients live in Florida, they have a nice house in Westchester County, and they're probably going to transfer that house to a partnership, but I can't guarantee it'll work, but it might. If you do this with a non-spouse, which I almost certainly wouldn't recommend, there's also a lot of gift tax implications. If a client enters into a partnership with a child who's, again, it can get super complicated. You'll probably end up with a gift, and you don't want to do that unless that's exactly what you want to do. Although I'm talking about New York, I know you're going to ask me about Connecticut, so I thought I would just mention Connecticut will not respect the transfer to an LLC as changing the nature of a real estate interest if you don't have a business purpose, and typically for this purpose you would not. So it won't work in Connecticut either. I'm now going to talk about New York taxation of trusts. And just as an overarching theme, every state taxes its trusts differently. It's just a kaleidoscope of rules. And as a result, there are some opportunities for structuring a trust in order to avoid state income taxes on a trust. And I have had situations where miraculously a trust has had no state income taxes because it didn't, it sort of fell between the raindrops of all the state income tax rules. Connecticut rules, just brief review. If you have a Connecticut settlor or decedent, then it's taxed in Connecticut. Full stop. If the trust is established under an inter vivos instrument versus a will, then you won't have Connecticut tax if all the beneficiaries are outside of Connecticut. But the residence of the trustees is not relevant at all. However, New York is different. So what New York says is that first, it looks at, did you have a New York resident when the property was transferred to a trust by will or during lifetime? And if that happened, then it's, generally speaking, it's going to be considered a resident New York trust. So the classification of whether it's a resident New York trust is important. And once it is classified as that, then it's taxed in New York unless, and I'll go into the next steps. And then a non-resident trust is anything that's, this is in the law. A non-resident trust is any trust that's not a resident trust. So far the rules are roughly the same as what we have in Connecticut. So what New York says is that even if you have New York resident trust, it can be exempt from New York income taxes if you meet this three-prong test. And if the trust does meet this three-prong test, then it's not subject to New York income taxes. So rule number one, the trustees will have to be domiciled outside of New York. Number two, the trust property, all the trust property has to be outside of New York. And number three, no New York source income. So trustee domicile, it's all or nothing. It's not proportioned. Some states, like California, will look at how many trustees are in state versus out of state and tax proportionately. New York's not like that. It's all or nothing. You could have 10 trustees, and one's in New York, boom, you're not going to meet the test. New York will also look at what the people are doing. So here in Connecticut and Delaware, and it's sort of moving, throughout the country, we have this concept of directed trust. So in a directed trust, the traditional trustee roles are broken out into different pieces. So you might have an investment advisor or director, a distribution advisor, a director, an administrative trustee. So in New York, they're going to look, so even if you have that kind of setup, New York's going to look at what are these people doing? And if you have that situation and any of those actors are performing traditional trustee rules, they are going to be considered a trustee for purposes of meeting this test. Let's say you have a New York client, they're the investment advisor, they're still in New York. You're not going to be able to get that out of New York unless they come off. The next prong is having the property located outside of New York. Third prong, it can be a little tricky. The trust can't receive any New York source income. And where it can get, you can get tripped up is, quite honestly, with partnerships or real estate partnerships, real estate investments. A lot of you in here can explain that a lot better than me, but what I do know is that you might get a K-1 or a 1099 that's going to show, maybe even bond funds, I would guess, you know, New York source income. And if you have any of that on the client's tax return, boom, you're not going to meet it. So you're going to need to organize not only where the trustees are and what the trust owns, but also really deep dive into the ownership to make sure there's no New York source income. But if you can do it, it's going to save you a lot of money because the rates are really high, particularly if you had a New York grantor who lived in New York City, which sort of bumps things up even more. Another piece, though, is that, you know, this is such a great rule, right? It's really can be very powerful and save a lot of money. So, but New York wants to know what's going on. So even if the trust is, you know, you've met all the rules, you're not paying New York income tax on the trust, you still have to file every year. And also, if you have a New York beneficiary, there's going to be an accumulation tax, which I'm not going to get into. The accountants in this room can figure things like that out a lot better than we can. But I just, again, heads up, you know, just you have to be very mindful of the care and feeding of this kind of situation. Second to last topic, and I'm not going to get into this one in any detail either. What an ING, an incomplete non-grantor trust. It's a non-grantor trust that's funded with an incomplete gift in a state that doesn't have an income tax. We don't do them in Connecticut because they don't work. New York in 2014 enacted some legislation that also says it doesn't work, so I'm not going to talk about that either. Just to say, don't do it, you can't. Finally, so we do, you know, a fair amount of New York probate, and what we have found when we submit wills to a surrogate's court is that, well, let me take a step back. Typically, in most of our documents, we ask the fiduciaries and the family to refer for any memorandum I might leave for the disposition of my tangible property, my stuff in the house. And that's nice, and it gives clients a lot of comfort, you know, that their wishes are going to be respected. However, if you have that language in a New York probate proceeding, the surrogate's court is going to ask you if there is such a memo. So now you've got to go look for it, and there may or may not. And if there isn't, you have to file an affidavit. And it's just kind of complicated and an unnecessary speed bump to getting something probated. So we routinely will actually eliminate that language in any New York document, and that's something you might want to look at for your clients, because it definitely makes it easier to probate. It's hard enough to probate things in New York. You know, why make it even more difficult? So thank you